And we've been telling you ad nauseum that the numbers have beaten estimates on all counts. Retail business has seen stellar growth. Telecom has remained stable. Debt has gone down, as well as, Capex has been done using internal accruals. Even the oil to chemical business numbers were above street expectations. Probal Sen, who's the energy analyst at ICICI Securities, joins us now. Probal, thanks for being with us on the channel. You've had, 48 hours to digest the numbers. What has your biggest takeaway been, and how are you approaching the stock now?
No, I think, yeah, as you said, the numbers are fairly strong, and I think that is very, very encouraging. We've said consistently over the last, I think, couple of quarters, or maybe even more than that, that the earnings growth from Reliance is going to continue to remain peer leading, particularly in their market cap category. And I think that is something that is playing out. The OTC segment outperformance was marginally ahead of our and street numbers, I would imagine. Retail was a bit of a surprise. I think more than that, the performance from the upstream segment, where guidance is being met or exceeded, particularly on the production front, consistently. I think that is something that is probably also an additional lever. The net debt reduction, if I can, probably, sort of clarify that, I think the incoming flow from the fresh retail investments probably had more to do with the net debt reduction than any debt repayment or, the improvement in cash flows. I think if you look at the kind of extent of debt reduction that has happened, it's probably driven by the additional inflows that have come through. And I think we are going to see that benefit in the next quarter as well, since one of the three tranches of investments, I think by RDA is likely to flow through in the next quarter. So that benefit is obviously going to flow through. So to that extent, I think we are encouraged by the earnings momentum. Our stance always has been that the company needs to sort of start to show that reduction flow through to FCF yields and return ratio improvements, which I think is probably still slightly some time away. And I think that is why we, rather than having a full-throated buy, we have a more cautious ad rating on the stock. But given the way that the stock has underperformed in the recent months, we very clearly see that the stock can actually rally post these results. And our estimates indicate around a 14 to 15% return from the name over the next 12 to 18 months at about 2,600 rupees. That's our fair value for the stock.
Okay, your fair value is 2,600 rupees. Are you also factoring in the improvement in the balance sheet? The debt has gone down, and now their capex amount, this $35 billion capex is now, the monetization of this capex is starting to pick up, right? So that's also funded through internal accruals. So the balance sheet is improving quite a bit. Is that something that you've already factored into your target price?
Yes, absolutely. I think given the fact that I think there are two things to it. One is that the capex this year, if you see, I think is still probably a bit ahead of our and street estimates. I think the quarterly run rate, ideally, I mean, if we just go back about 2 years ago and, looked at what people were saying, or even a year ago, we would have expected that the annualized capex should have actually slowed down to about $1 trillion or so for the full year. That doesn't seem to be the case. I think if we look at the capex run rate, specifically with the aggressive 5G rollout as well as the aggressive build out continuing in the retail space, it does look like even in this year they're likely to do somewhere around 1.3 to 1.4 trillion. So that is still slightly ahead of what we were looking at, but we are encouraged by the management commentary which stated that from FY25 capex intensity should start to go down. So to an extent it's obviously built in. But what we have seen, unfortunately, earlier is that capex has tended to be slightly ahead of, more optimistic projections, because there is some new capex or new projects that keep coming in. And we are still not sure about the phasing of the new energy capex, which is the next big trigger, plus a more aggressive round of petrochemical expansions that are likely to happen, specifically with respect to their Middle East JV. So, if you put it together, the run rate probably will go down a bit from here, but we would still expect it to remain at somewhere around the 1 trillion mark, even for 25 and 26, which, means that net debt improvement will be only gradual, at least over the next 12 to 18 months.
Okay, all right. Prakash, come in on this. There's a lot that's going well for Reliance, right? Across businesses, they're doing well. Retail was fabulous this time around. And as we've been pointing out, the balance sheet is also improving. From a stock perspective, what kind of an upside do you see? Because the stock is still off 20% from its 52-week highs. Do you see it get back to that level anytime in this calendar year?
Sonia, I just want to add, apart from the improvement in the balance sheet and, the kind of performance on retail and O2C, don't miss out on the fact that they've added one of the highest levels of subscribers, at 11 million this quarter. And while the ARPU might not capture that, there's lots more coming, as the 5G rollout gets completed. So yes, to answer your question, I think it's definitely undervalued, it's under-owned, and that's precisely because of a lot of outflows in from the institutional side, the ETF segment. But, in the next couple of months, the market will start realizing that if you were to play the market in terms of, these segments, the consumer-facing businesses contributing so significantly, probably Reliance happens to be one of the best bets with a slightly longer-term view. So that ownership change from under-ownership to even a moderate level of interest will probably bring back the stock to those 25, 26, 2700 zones. And then, of course, it'll consolidate to go up beyond the 3,000 mark very soon next year. So I'm quite positive. But yes, the market also needs to like that and has the same kind of a thought process in terms of timing and attractiveness.
Okay. Prakash and Probal, thanks very much. Well, stay with us, Prakash. We'll come back to you for more in a bit from now.